Hello and welcome to Young and Financially Empowered, the financial lessons for those in their 20s. My name is Todd Christensen. I am Director of Education at Debt Reduction Services, Inc., nonprofit credit counseling agency, and I appreciate you joining me today. What I'm going to be going over are some of the issues that are particularly challenging to individuals in their 20s, and we'll talk specifically about debt as well. And so as we get into this, you're welcome to pause this class at any time to move forward, move backward, whatever works for you. You will need, if you want to take the quiz and get credit for taking this class, this webinar, you'll need 3 of the passwords that are provided throughout this presentation. So you may want to have a paper and pencil handy. And then you can return to the page or the website where you access this webinar at debtreductionservices.org, and you'll find a link to our quiz there as well. So as you may know, we are a nonprofit credit counseling agency, been around since 1996 with offices around the country, although most of our services are done by phone and online. And we do provide probably 200, 300 classes a year in financial education, the basics here. All right, so here's what we're going over today. Signs of trouble. If there's such thing as good debt, bad debt, we'll talk about predicting outcomes to decisions that we make. Options for getting out of debt. And the steps to do so. We'll talk about bankruptcy, what its implications are. We'll talk about some of the different loans that are available out there, particularly the very high fee, high risk loans. And then we'll talk about consequences that we may incur for different choices that we make. Okay, so to begin with, I'd like you to think of where you want to be financially, whether this might be in a year or 5 years or 10 years or further down the road. Where do you want to be? It might be that you would like to have an enjoyable job, steady income, make a comfortable living. These are fairly generic answers. You might want to think about, oh, down the road, I want to retire early. I'd like to work to be able to retire early, travel maybe. I'd like to have no debt, especially no student loan debt. It's pretty common for people in their 20s. Maybe it might involve relationships. I want to have a lot of good friends, be able to spend time, quality time with my family, and as I mentioned, maybe travel the world. So think about, honestly picture, where do you want to be financially down the road? And then ask yourself the question, where am I now? How close, how far, where am I in relation to where I want to be? You know, if I want to have an enjoyable job, do I have a degree? If I want to make a comfortable living, am I living below my means? Virtually at any income, it's the only way to be comfortable. No matter if you could be making 3-4 times the average or median income in this country, and if you're spending all of that, as 60% of Americans are living paycheck to paycheck, that's not comfortable. You can be uncomfortable at any income. Early retirement, have you made a plan? Are you looking at ways to start your own business or ways to heavily invest in your 401k, IRA, purchasing a home rather than renting long-term? These are some of the ways to look at getting to early retirement. If you don't want to have debt, you know, are you making a plan to pay off that student loan and other debts? So where you are now, and what are you doing to get there? Are you content? Are you happy with where you are now? Do you feel like you're making progress? If so, you probably have a plan in place, and you're going to continue to make that progress. If not, what we're going to be talking about right now, just to begin with, is how to improve your chances of getting where you want to be. And this, this is a point where you can pause it or come back to this later, but think of 3 things that you will absolutely have to do in order to reach that goal or those goals. What are 3 things that you're going to need absolutely to accomplish in order to be where you want to be? And then you can need to commit to those steps, creating a plan and committing to it. Committing is not just, well, yeah, I'm going to do it. It's telling yourself, even out loud, regularly, writing it down, putting it somewhere you're going to see it. You want to increase the chances of reaching that goal. Write it down, share it with somebody that will hold you accountable, that will ask you about it fairly regularly, every few weeks or every couple of months, and then report to them. Make sure that there's somebody that will be motivational for you. And then we'll come back to this here a little bit later, but think about one thing that you can do today, one step in the right direction. You're going to write it down, you're going to set a reminder on your phone or on your calendar, and you're going to do that within the next 24 hours. If you don't, then it's likely that this entire webinar and your entire journey to where you want to be is going to take a detour at some point, and most likely pretty soon. So this is the first password you need to have in order to complete the quiz. It's 20s, TWENTIES, 20s. Okay, so let's talk about some of the signs of trouble, financial trouble specifically. I'm going to go through some of these questions, and if you can answer yes to any of these questions, or if you answer that sounds just like you, or if you don't think it would be a problem either way, those are both signs that there's some issues you're going to want to address in your finances. And this may not be news to you. Most people who are in financial trouble understand that they're in financial trouble, but there are some who try to blissfully go along without trying to ignore it, which never works out in the end. But for example, with debt, can you not make your standard student loan payment every month? Are you unable to make that standard 10-year fixed payment, or are you looking for other repayment options? If so, there's some financial issues going on. Is your car payment and the insurance that you pay on your car more than 15% of your net pay, unless you are making 2 or 3 times more than the median income in this country, which is about $50,000 as of 2014? You're probably paying more for your car than you need to. And think about it: if your car payment and insurance and maintenance and gasoline, if that adds up to 20% or 25%, and in some cases I've seen it up to over 50% in some households. But let's say 25% of your household income, that means that for the first 2 hours of every day that you're at work, you're just working in order to make enough money to get to work and home. You don't actually start making money until that 3rd hour. So make sure that you minimize your transportation costs. Next one, are you carrying a balance on your credit card from month to month? Yes, 2/3 approximately of American credit card holders carry a balance. That does not mean it's a smart or a good choice, or that it should be acceptable. Do you borrow, or are you considering borrowing from family or friends just to pay some of your common living expenses, rent, to pay meet some of your loan obligations, so forth? Have you gone over your credit limit on a credit card? Are you making only minimum payments on your debts? Yes, some might be very low income, very low interest, but generally we want to get out of debt as soon as possible. Have you taken out, or are you considering taking out a payday loan, an advance? Have you asked for an advance from your employer? Your collective minimum loan payments, excluding mortgage. But if you take all the minimum payments on your loans, are they more than 20% of your monthly income? And your credit card interest rates, have they been changed to what the industry calls the default rate, which is essentially a penalty rate, typically in the 20 or 30% range? These are all signs that there's some debt issues that really need to be addressed in a fairly aggressive way. When it comes to banking, do you regularly ignore your bank statements versus actually balancing them regularly? Have you had debit card purchases declined? Do you not even have a checking account at a bank or credit union? When it comes to bills, are you regularly missing payments on some of those bills, whether utilities, cell phones, so forth? Do you have savings? Do you have no savings or very little savings? And generally, questions like, are you working overtime to pay your living expenses? Have you delayed doctor visits for financial reasons? Have you pawned, or are you considering pawning possessions to pay for living expenses? Have you used or are you considering using a rent-to-own location to obtain a piece of furniture or electronics or an appliance? Or do you just generally lose sleep because of financial worries? These are all, and many more, of course, signs that we really need to pay more attention to our finances. Let's talk about debt now, specifically about debt. Many of you have probably heard there is good debt, there's bad debt. Personally, I believe that good debt, bad debt is not the way to approach a debt and how we look at it. I prefer considering debt as either potentially good, as practical, or as bad. I'll keep one of those two. But potentially good debt essentially is a debt that you might use to increase your net worth or net income over time. But practical debt is something that would be paid off in full every month where there's no interest being paid, and everything else would be bad debt. So with those three in mind, that potentially good debt is something that would increase net worth or net income. Practical debt is paid off every month, and then bad debt is everything else. Here's some of the things that you can think about. What would you say these are? A payday loan, or a payday advance loan. Those, of course, high interest rates. We'll talk about those a little bit later. Home loan, potentially good, because over time, the value of the home goes up, not much more than what we have paid on it, but versus rent that goes up every single year, and at the end of the term, we don't get any money back. Home loans can increase our financial net worth. Student loans, potentially good, because for every degree that you earn on average, your income can increase dramatically. That is a generalization, of course. There are some degrees that don't increase our income much, but generally, a bachelor's degree versus somebody who only has a high school diploma is going to earn almost double throughout their lifetime. That's right now about an extra $1 million in their lifetime for a degree that probably costs somewhere between $30,000 and $50,000. Business loan, potentially good, but very risky. Could turn out to be great income, and most financially wealthy, successful people are small business owners, but not all. Home repair, again, it might be potentially good if it's for something that actually increases the value of the home. Home repair for something that just is something we want to fix that's not going to bring the value up would be much better. We'd be much better off having saved up some of that money and earned a little interest on it versus borrowing at any kind of interest rate. So those are the potentially good debts. Really the only practical debt is if you use for example, a credit card when you're traveling, or if you use a credit card to make one purchase a month and pay it off automatically every month, and that you never pay interest on it. Typically, carrying a credit card around, and even if you pay it off every month, not a good idea, because even if you're not paying interest, you're usually spending about 10 to 15% more than if you were just use cash or check. Debit card, the same thing. You're going to spend more using a debit card. Virtually everything else, including a car loan, which a lot of people might disagree with me, but car loan, cars go down in value. It's never going to be investment. Even those classic cars, you either have to pay high amounts for them or keep putting a lot of money into them to keep their value up, or just get extremely lucky, as is the case with most collectibles. But credit card consolidation loans, typically bad. They can be practical if somebody is very disciplined, but most people who take out a consolidation loan for credit card debt end up with that new consolidation loan, plus they run their credit cards back up, and so now they are in twice as much debt. So it's typically a bad idea. Tax refund anticipation loan, also not a good idea. Okay, so let's do some predicting. What do you think when you hear these? When you see these, this is from the handout. You can find this handout on our website. This is what might happen when you start missing payments. What are some of the common consequences if you miss a payment on a loan? Here are a few possibilities. Let's take a look here. You've got TV might be repossessed, be denied an apartment. You might have poor health, divorce, lose home to foreclosure, be charged high interest rate, pay higher car insurance. Some of these don't even seem like they should be related. Unable to sell home, be kicked out of college, be denied a loan, be refused utility accounts, require a large deposit, lose a job, pay extra fees, not get hired in the first place, have a college degree canceled, go to jail, file bankruptcy, be refused a cell phone, have your vehicle repossessed. Okay, so if you want, look those over again and see what you think. Which ones, it's probably easier to figure out the ones that are not, that you would not circle, that are not answers, that are not possible consequences. But you can pause this, come back in a moment. But here are the answers. Potential consequences would include all of these except, one, going to jail. Unless there's fraud involved, we can't be thrown in jail for not being able to make a payment. We could have our wages garnished, of course, but we're not going to go to jail. TV repossessed typically doesn't happen. You make a purchase, you buy a TV with a credit card, and you can't make the payments on the credit card anymore. They're typically not going to repossess the television. Credit cards are unsecured loans, so they're not secured against any property like television or real estate or anything like that. Denied utilities. You cannot be denied utilities if you miss a payment or if you have bad credit. Now, you can be denied further utility accounts if you get really behind and you want to apply for a loan or apply for an account. They can deny you that utility account. But if it's just because you have bad credit, they won't deny it, but they'll probably give you a higher loan, require you a greater deposit. Of course, even if you don't make your payments for your student loans, you can't have your degree canceled. That's not an issue. You're not typically going to be kicked out of college. Most of the time, if you're in college and working more than half time, so you're not, your loan repayments are going to be deferred. Maybe the interest, if it's an unsubsidized loan, the interest will be building, but typically you're not going to get kicked out of college because you're not making payments on your loan. So let's talk about getting out of debt. What are the steps? 3 steps to getting out of debt. Seems pretty simple. We'll break them down a little further than that. But first of all, 1, stop the slide. We got to stop getting into more debt. Stop using any kind of debt vehicle, which would be credit cards. Stop using the credit cards. Stop using loans that borrowing from one place to cover debt on another. That is not getting out of debt. That's moving debt around, and usually there are the fees and the interest involved make things worse. 2, create and live by a spending plan, also known as a budget. You could even every morning ask yourself or repeat to yourself in the mirror, I'm going to live by a budget today, and do it throughout the day. Remind yourself. It'll build your confidence and your comfort level with actually living by a budget. And the third is simply modifying our spending habits and our behaviors. This might involve getting rid of some expenses in our lives that we can't afford or that are more than we should have if we're going to try and get out of debt. So those are the 3 basic steps to getting out of debt. Now, what goes into a spending plan? Because that is a big part of getting out of debt. 1, establish and write down 1 to 3 goals, and one of those goals might be, and these got to be important goals, but one of them might be getting out of debt, paying off all your debts, being debt-free. And then once we've done that, then we get into the adding the income. Step 3 would be subtracting the expenses. And then step 4 would be figuring out a way to either increase income, reduce the expenses, or both. That's the essence of a spending plan or a budget. Now, what spending habits you have to consider? What are the spending habits or behaviors that you might need to change in order to live below your means? Because we've always been taught, live within your means, but that's living paycheck to paycheck, living within your means. We have to live below our means. Think about the success you've had, or maybe some of your friends or acquaintances or family members have had in overcoming negative spending behaviors. A few of those types of behaviors that we need to deal with, that quite a few of us have. 1, impulse spending. We all know what impulse spending is, buying something we didn't plan for. One way to get through that is creating a goals card. Those goals that we mentioned previously, write them down, put them on a card, put it in your wallet, your purse, somewhere where you're going to have to see it when you reach for money that you are all of a sudden feel like you have to spend. It's not a guarantee, but it's going to help us think twice about spending on something that we didn't have planned. If you're a sales spender, someone that you can't pass up a good deal just because of the store. Just remember, just because the store says it's a good deal doesn't mean it is. Quite often those prices might be marked up 20, 30%, and then they'll mark them down 20, 30% after a couple of days so that they can say it's on sale. It's a way of raising prices. Make sure you never shop in percentages. Sales spenders, I can pick them out of a crowd whenever they talk about how much an item cost, what percent they've saved on an item. That's somebody who's going to spend themselves right into bankruptcy that way. Bad timing spending. Don't ever shop when you're hungry. We know that. Don't go to the grocery store when you're hungry. Don't go to the grocery store when you're stressed or shopping generally. Don't go when you're hurried, and then don't go to the grocery store when you have little kids with you. You'd actually save. Most households would actually save money. Remember this: if you don't have kids now, or if you have kids in the future, you'll actually typically save money if you hire a babysitter for an hour while you go to the store, because children will typically lead their parents to spend about 15% more than they would have by themselves. Entitlement spending, that's, hey, I deserve this. I've worked hard. I worked just as hard as so-and-so down the street, and look what they've got, or look what they bought. Entitlement spending leads to spending on things that we really can't afford. Remember that what we're entitled to is a healthy financial situation. And then the last one, compensatory spending, where we're buying things to make up for a sense of maybe a little lack of confidence, we need to understand that our self-worth is in our values, not our valuables. Don't ever put your identity in what you own. Okay, second password, Twilight, T-W-I-L-I-G-H-T, Twilight. I'm going to go ahead and write that down. Okay, options. Now, how do people get out of debt, or how can you deal with too much debt? What are some of the consequences? This is what we're going to talk about right now. First of all, think about if you are paying as agreed. What that means is you're making all the requested payments until it's paid off. You can pay on your own, of course. That's the preferred way. Make all your payments to all your debts until they're all paid off. You're going to build your credit while you're doing it. You're going to lower your debt load, and you will be obliged to nobody financially once you're paid off, except, of course, to Uncle Sam. Other options, another option that people will look at using is transferring debt from one loan to another, particularly credit cards. Open one credit card, transfer from here to there, and that's not paying off debts. That's actually just moving debt around. And there can be some problems, especially if the transfers don't happen on time or as expected, or there's interest rates that are, or fees that are added on that you didn't realize they were going to do that. So transferring debt from one card to the next, I'm not saying it's not a good answer, but for a lot of people, it's just delaying the inevitable. It's not paying down debts. Asking creditors for a lower interest rate, this can be a great opportunity. If you only have one card and your interest rates have gone up, call your credit card company and ask them to lower your interest rates. If you have multiple accounts, though, it'd be more likely that they would prefer to refer you to a credit counseling agency. And as you can see, if you look on just about any credit card statement, it lists numbers to credit counseling agencies or associations. Another option people look at is consolidating debts into one loan. Unlike transferring from credit card to credit card, some people will actually try and go out and get a consolidation loan. It sounds easy. It is not. Most lenders do not want to take on the risk. If you're having a hard time paying multiple debts, that means that you're pretty high risk. And if they actually do approve such a loan, which is certainly not a given, it's quite often can be at a fairly high interest rate. So, and then again, like a home equity line of credit, where somebody will take out a loan against the value of their home compared to what they owe on it, they will now have that loan, and they're tempted to run their credit card balances right back up. About 70% of people do that within 2 years. Using a nonprofit credit counseling agency, as I mentioned, works to lower interest rates, stop over-limit and late fees, make your repayment much more affordable. It takes up to 5 years, typically about 3 to 5 years. There are some fees. They are capped by state. They're fairly reasonable. There is no lasting impact, direct impact on credit scores. There are indirect impacts that can happen, but a notation that typically goes on your credit report if you're participating in a debt management program through a credit counseling agency will come off once you're off that program. And you can pay off anytime early. You don't have to go the full 5 years if you're able to pay it off earlier. Debt settlement companies, these are companies that try to lower the actual amount of money you owe. Unfortunately, rarely succeeds, as far as I am able to find out from third-party organizations and agencies, is that the success rate is in the single digits, mid-single digits. And typically it's more common that they end up in a judgment with wages being garnished. And then there's bankruptcy, which tries to eliminate all financial obligations, and yet there are some, such as child or familial support, student loans, recent back taxes, and other recent debts that typically can't be eliminated through bankruptcy. And the last one that is really not an option, but people think it is just to ignore the debt. It might go away. It's just not going to go away. Unfortunately, that's not an option, and there are consequences to that. So let's talk about bankruptcy. What are some of the issues of bankruptcy? Why do those 20-something bankruptcy filers, and there are quite a few of them, it's one of the fastest growing populations filing for bankruptcy, why do they typically file for bankruptcy when they do? Well, here are some of the most common reasons that 20-something might file for bankruptcy. First of all, understand only about 35% of them have a mortgage when they file. A lot of people think bankruptcy is just for saving your home. For 20-somethings, and these are all based on the surveys that we did between 2006 and 2013, so that was kind of an anomaly period because of the Great Recession. But about 35% of them had a mortgage. So only 65% filed for bankruptcy without a mortgage. 45% had $20,000 to $50,000. Almost half of them had $20,000 to $50,000 in non-mortgage debt. Most of that non-mortgage debt was credit cards. 73% of filers had credit card debt. 70% of filers had medical debt. 60% had vehicle. And I'll tell you from experience as as a bankruptcy counselor, talking to people as they're getting ready to file, that high car loan payments are just asking for bankruptcy. If you get into a car loan that is $400, $500, $600, you're very close. You're just a job loss away or a month without income away from filing for bankruptcy. 25%, only 25% had student loans. 24% had a mortgage. And 17% had the payday loan. So that 35%, I think that's the general population that had a mortgage. The most common reason for filing, these are self-identified reasons, 36% said it was because of job loss or income reduction. It was not medical. 26% did say it was medical, but most of them it was because they lost their job. 13% was for overspending. 10% was for overuse of credit cards. If you add those two together, it's 23% for personal finance issues, poor money management, and then almost 10% because of divorce, even in the 20s. So these are all issues that to be aware of why people file for bankruptcy. And this is really telling how much, we asked the question, how much savings did you have when you lost your job or when you got divorced or when you had your medical emergency? Essentially 70%, it was 68% had nothing, had no savings. And then almost everybody else, 27%, had less than $1,000 in savings. So that is 95% had $1,000 or less, only 5% had more. So savings, the number one thing you can do to put yourself on solid financial ground is to make a habit of savings. Okay, so let's talk about some high fee loans. And these are basically things to avoid, what you want to avoid when you're talking about borrowing money. Credit cards actually are among the more affordable loans. Probably the most affordable loans you'll find are car loans right now, home loans, and student loans because the interest rates are in single digits. Credit cards, the average credit card interest rate on an annual basis is about anywhere from 12 to 15%, unless you get into a default, and then it's 30%. But even that 30%, to be honest, is extraordinarily low compared to these other options. So listen to these. If you consider a title loan, this is a car loan. You own the car, and you take it to a title lender. You're typically going to get a 30-day loan. And if you will annualize that interest rate that they charge, it's typically somewhere between 50 and 100 or even 200%. A rent-to-own contract, the advertisements that you get in the mail or that you see for their deals, those are often weekly payments. And by the time you actually pay off whatever it is you're buying or renting to own it, you will have paid 100 to maybe even 500% of the price that you could get it for at another store. So if you were to be patient, pay yourself that same amount for a year or 2 years, you could actually buy 2, 3, 4, or 5 of the same items. So keep that in mind. One of those corner finance company stores, typically, or online one that will have a finance in the name and specializes in $500 to $10,000 loans. Those are usually about 20 to 50% interest. If you were to use your checking account overdraft, depending on how long it takes for you to pay that off, and depending on the bank or if it's a credit union, it could be anywhere from equivalent of 10% up to even 100% annualized interest. Credit card cash advances. You can get cash using your credit card at an ATM with the PIN, but that's typically going to be about 20 to 30% interest, and it immediately starts charging you interest. There's no grace period on that. Payday loans. I mentioned them before. If you take the fees that they charge and annualize them, it's because they're mostly 2-week loans. If you were to annualize them over a 52-week period, they equate to about a 400% to more than 800% interest. So very high. Pawn shop loans. I love shopping at pawn shops. Borrowing money at pawn shops is going to be expensive. It's probably anywhere from 50% to 100% or more interest. And then tax refund anticipation loans. When a place will do your taxes and they'll offer you cash on your way out the door, instead of having to wait that 2-week period to get your tax refund, they'll lend you money. Typically, those type of loans work out to be about 50% all the way up to 500% annualized interest. Not good ideas, and unfortunately, too many young adults are not aware of the dangers of these kind of fees. Either the marketing does not disclose it, or it's actually borderline deceptive or downright deceptive marketing. So we're getting close to the end here. Let's talk about the consequences. What happens when we choose these different repayment options? So this, again, it's called Which Repayment Option Rocks. It's another activity you can find on our website. And it looks somewhat like this. Which repayment option rocks? So draw a line. It's a match game on the first part. Draw a line from the option to what it means. We've gone through this already. So if you want to do the activity, go ahead and pause it now. But ignore, obviously, is attempt to stop thinking about a debt. That does not work. Debt settlement is trying to negotiate an actual smaller balance that you have to pay off. Credit counselors will attempt or will ask the credit card companies to lower your interest rates and typically lower your monthly payments and stop over limit and late fees. Paying off as agreed, best option if you can do it, is making that requested payment each month, and filing for bankruptcy is actually asking a federal judge, going before a federal judge, or your attorney going before a federal judge, to try and cancel your obligations. And then the second activity here, rank the options in order of the best impact on your finances to the worst impact. Number 1, paying as agreed is best. Number 2, using a nonprofit credit counseling agency with a 3 to 5 year payoff may have some initial negative impact on your credit, but over time, because you're making on-time payments and paying down to zero, in general has an overall net positive impact. Number 3, settling your debts for less than the balance owed. You can often end up in judgment and garnishments. That might actually be number 4 for some people. In some cases, it can be a really terrible situation. But number 4 is bankruptcy. It can take bankruptcy filers 1 to 2 decades on average to catch back up with those similar incomes and net worth. catch back up to them financially. So it does infer that at your age, in the 20s, the younger you are, the less drastic the impact will have throughout your life. I'm not one to encourage people to file for bankruptcy frivolously, obviously, but it is there for a reason. The fifth one that just does not work is ignoring your debts. Things will get bad, and they will get really bad, and they'll get worse. And each week or each month that you ignore your debt, your options get fewer and fewer. So to finish up here, let me give you your third password. It is tweeting, T-W-E-E-T-I-N-G, tweeting. So let's go back again to this idea of picturing change. And think once again, what is the one step? What is one thing that you can do today? If you don't do anything today, within the next 5 hours, within the next hour best, but certainly within the next 24 hours, you won't do it. That's human nature. There have been plenty of studies to show that when we learn something, if we don't apply it within the next day, we're just not going to get around to doing it. So what's that one step that you can do? Write it down right now. Write it down, post it somewhere, share it with a friend, share it with a family member, share it with somebody, and ask them to follow up with you or ask you about it every few weeks or every couple of months to see how it's coming. And you'll be much more likely to get where you wanted to go. There's no shame in this. We're far too worried about what other people are going to think about us and our financial situation. The one thing I've learned from studying people who are financially successful and have built their wealth and their fortune is that they're more than happy to ask people for help. Many of them have had great mentors, more than one mentor that they have approached on how to deal with their finances. Find a mentor, find 2 mentors. You'd be surprised most people who are financially successful are open to spending time helping anyone know more about money. So find a mentor, ask them if they can give you some suggestions. They don't go around offering it because most people are not ready for it, and it'd be a waste of their time. Okay, so the next leg of your journey, complete any additional workshops and webinars that we might have. You can go back to our website. This is part 1 of 4, but there are also several other series of webinars that you can look at. Can you open up any kind of a new savings account right now? Again, savings is the number one habit and behavior that you can develop to lead you to financial success and stability. So is it time to open up a savings account? Can you save an extra $1 this week? Can you put $1 in? Can you open up a new account and put $10 in online, in person, whatever you can do? Do it, and you'll not regret it. So appreciate you joining me again. Please do take advantage of our other services and our other programs, and you're always welcome to retake this class or any of the others that we have. Again, this is Todd Christensen with Debt Reduction Services, Inc. Appreciate you being here and hope you have a great day, and I wish you all the best.